Hello, welcome to this YouTube channel. I'm trying to use this channel as a way to study and learn the equity derivatives products. For derivatives, it actually includes a lot of different type of underlyings like equity, interest rate, credit, FX, commodity. But I will try to mainly focus on the equity derivatives products. I will try to analyze the product from a pricing, trading, or hedging perspective, which I think is the core part of understanding the products. And this can, reflect the true nature of the product features. Okay, let's go to today's video. So for equity derivatives, from the name, you know that this is, derivatives. Whose value is derived from the underlying equity security. So the underlying is equity rather than interest rate or FX. As to specific derivative product, there are a lot like futures, swaps, options, convertible bonds, exotic options, hybrid, etc. In the bank, generally, these products are, classified according to the business. Different desks manage different type of equity derivatives. For example, Delta One, flow, convertible bond, exotic, and hybrid. So for the other one, for example, basically this kind of product, from the name we know, is the delta of the product is 1 or close to 1, like ETF, futures, swaps, equity swaps, or forwards, products like this. So basically, the fair value of the product is some kind of linear combination of the underlying. For flow, basically, the includes a lot of like the core put options, American options. They constitute a large volume of the products the banks trade every day. So that's why they are called the flow business. And convertible bond, exotic. Exotic is a very important area for the derivative desk. They, can composed of very complex structures and very complex features, and can be made very customized to fit clients' needs. And hybrids, basically, that means the underlying is a mixture of equity, interest rate, or FX. So to price the hybrid product, you have to use a combination of models from different underlyings. Okay. Let's take a look at the simplest equity derivatives products, which is the call or put options. I believe a lot of people have known these products. They actually generally classified as vanilla products belonging to the flow business in the bank. So for call option, the definition is it gives the buyer the right to buy the underlying equity from the seller at expiration date for a certain price. This certain price is called strike price. So similarly, we have the put, which is the other side, which means the holder of the put option have the right to sell the underlying to the buyer at the expiration date for the strike price. We can give I can give you a good live example. For example, as of December 19, 2020, the Apple stock price is 126.66 US dollar, and there are a lot of Apple stocks options traded, and you can find one. For example, one of the call option on Apple stock is expiring on December 31st. The strike price is 126. That means on December 31st, if the Apple stock price S is greater than 126, if you are the buyer of the option, you will exercise the option because exercising it will be in your favor, and you will make money by exercising the option. Otherwise, you will not exercise. The payoff of the vanilla option is very simple. It's for example, for the call option, the payoff is maximum S minus K 0. S is the spot price on the expiration date, and K is the strike price. So let's use the previous example, assuming, but this, on the final expiration date, according to whether the call option is cash settled or physical delivered, the settlement can be a bit different. So if it's cash settled, that means assuming that your counterparty is the bank on the final expiration date, if it's cash settled, the bank just give you, using our previous example, assuming you bought Apple or call stock, call option with a strike price of 126, assuming on December 31st the Apple stock price is 130. Then on December 31st, you will exit the option. If you exit the option, then the bank will give you $4. That's done. So very simple. But if it's physical delivered, then this is going to be a two-step process. The first step is you exit the option with $126. So that means you give $126 to the bank. The bank will deliver one share of Apple stock to you. And to realize the $4 profit, you have to, once you get the one share of Apple stock, you can immediately go to the market. So you sell the one share of Apple stock to the market and obtain 130 US dollar. So your net profit is 130 minus 126, which is $4. So this is the example of how you realize the profit by exercising the option. Some of the people might be interested to ask this question. From this example, kind of like you made $4 of profits by exercising the option. Of course, you have to, deduct your option premium that have paid to the bank. So, assuming, for example, it's $1, then your net profit is $3. So some people might ask this question. So how about your counterparty, the bank? In this case, you made money by exercising the option. But how about the bank? Is the bank losing money? Kind of like the bank is losing money, but actually, in reality, the bank is not losing money. A general question is how banks make money by issuing the equity derivatives. Banks will try to make money for each of the product or each of the security they sold to the client. They actually are never betting that the stocks will go in the way that is in their favor. So they're not betting. Actually, they are more or less neutral. So although in the previous case, seems you made money, but your counterparty, the bank, is not losing money because they have hedged their risks after they sold the call option to the client. But this can only be achieved only when the bank has a very good pricing model to price the product fairly. As to what is fairly, we will discuss about this later. But one thing that you need to know is that the bank has to have a very good model to price the product fairly. Otherwise, they are likely to lose money. After the bank sold the product to clients, actually there are two items exist on the bank's book. Firstly, the option side, which record the fair value change of the option. And secondly, the stock side, which is used to hedge the fair value change of the option side. So these two kind of offset each other. So finally, what we will say is something like this. On the option side, the bank might lose money, but on the stock side, they will make money. So the stock side will kind of compensate the loss from the option side. Let me use a very specific example to illustrate this. I'm trying to use a Black-Scholes model to price the vanilla call or put options. Black-Scholes is a very widely used and accepted model to price vanilla call or put options, and so we can see this is a relatively fair model as long as you can input the good parameters. Assuming that we have a call option, spot is 100, strike is 100, expiry is half year, interest rate is 2%, volatility is 20%. If you put these parameters into Black-Scholes formula, you will find that the option premium or fair value is $6.12 US. So after you bought this option, assuming we have such a spot realized path, initially spot price is 100 and finally it stops at around $123. So in this case, if you are a call option holder, definitely you will exercise the option at expiry, and you will make a profit of 123 minus strike equals 100. So you will make $23 of benefit for each option you bought. But of course, you have to minus the option premium that you paid to the bank. So finally, your benefit is $17. So your counterparty, the bank, will lose $17. So the bank's profit is negative $17. But this is only for the option side. The bank, after they sold the option to you, internally they will do their hedging on the stock side. And that delta hedging will compensate for the loss that is realized on the option side. So finally, what we will see from the bank perspective is something like this. So we have the realized P&L, which is the option side. They finally incurred $17 of net loss, but on the delta P&L side, which is the stock side, they are having around $17 of benefit. So overall, this blue curve shows the overall benefit is almost zero. So in reality, when the bank sold the product to clients, they will charge a little bit higher than the fair value. So what you will see in reality is all these P&L curves will be shifted up a little bit by this extra charge. So that is the overall P&L the bank made for this specific position. So you can see from this example that the bank is actually not betting the direction of the spot price movement. They are kind of neutral, and as long as they have a very good model to price the structure fairly, they can issue the product to the client and charges a little bit higher as their overall profit and loss. But as they sold hundreds of thousands of such positions to clients, so overall they can make a lot of money. But specific for each position, they might not have a lot of profit. Because they have to hedge all of the risks existing in the position. Generally, banks are not allowed to take huge risks for the derivative positions, so they have to hedge the risks away. Okay, that is all for today's video. If you like the content, please subscribe, and if you have any questions, just let me know. I will update the video on a weekly or bi-weekly basis. If you have any specific topic that you are interested in, you can let me know. I may also have some video to discuss the content that you are interested in. Okay, that's all about the video. I'll see you next time.